Before Greg and I start discussing what the views of managers were, I think it's worth reiterating NZM's investment philosophy, what we're trying to achieve. Our first priority is always preserve capital. Don't lose capital at any cost. Our second priority is to make as much money as we possibly can, provided we don't lose the client's capital. So over the 24 years since 1991 when we began this business, we've only ever had 4 negative calendar years. We're also proud of the total return that we've been able to generate over that period. $1 invested in 90-day bank bills or global shares is worth $4 today. $1 invested in NZAM is worth $6. And that has not come by shooting the lights out when markets are running hard. That's come by preserving capital when markets have had large falls. This would have been one of the more interesting trips that we've had for a number of years. There was certainly real clarity as to the views of the world expressed by managers. There was almost a consensus on those views, not always, but more of a consensus than we've seen for quite some time.
Yeah, so in many ways it's a strange world. If you think about an alien coming to Earth and reading, an Economics 101 textbook on the way down, and the alien arrives and finds that in the 3 major developed markets of the world there's been a massive money printing operation, that short-term interest rates are 0 or negative, that bond yields in some cases are 0, and that commodities have in many cases halved. The obvious conclusion is that the world is mired in deep depression. However, equity markets have rallied really hard. They're at all-time highs in many cases, and economic growth actually is fine. So the alien is confused, doesn't know quite what to make of the environment.
Just the point on the oil price fall and why that's so significant is that for most countries they're net importers of oil, and the big beneficiaries of this much lower oil price, which is like a massive tax cut, is Europe, is Japan, and is Asia. And it's hugely positive for those economies because their cost to import oil has halved. It's quite significant. So this is filtering through into a recovery in Europe that we weren't seeing 6 months ago, helped by massive quantitative easing in Europe. So there is a positive view being expressed by anybody with an exposure to Europe. They are starting to feel a little bit more positive about the outlook there. Japan was the other one.
Yeah, no, Japan is particularly interesting to us because it's really been a forgotten market since its peak in '89. People have given up on Japan. And as Alan said, you've got this huge quantitative easing program underway. Much like Europe, it's a beneficiary of lower oil prices, of a weaker currency. But also there's corporate change going on. There's a whole change in the culture of Japan, in the sense that return on equity, shareholders, dividends, all these things are now important. And we think we've found a manager that is ideally placed to capture this change.
From a markets perspective, as Greg says, we've got negative bond yields around the world, almost sort of unprecedented. Hard to see how they can go lower, but we thought that when they were at 0 and they've gone negative. We have equity markets in the US that are at all-time highs. One of the things that has been driving markets, and equity markets in particular, over the last 6 years has been the low US dollar and therefore US equity market performance. This strong US dollar is filtering through in a negative way to the US equity market, primarily because a third of US S&P 500 earnings come from overseas. So that's really requiring the 2/3 domestically focused to give a big earnings push, and we just don't see that happening. We can see economic growth being good, but if you have this big economic push in the US that would support higher earnings, then you're going to have the US Federal Reserve coming in behind that with much higher interest rates than the market's pricing in, which is ultimately not that positive for negative equities. That are kind of like that. So we have the driver of what's been the driver of global equities for the last 6 years, the US, no longer looking at all attractive, and we're starting to see managers lightening their exposure to that part of the world with an increase into the areas that we've been talking about, Europe, Japan, Asia, sort of the areas that they're quite excited about, not just from an equity market perspective, but from an economic growth perspective as well.
there's a much higher degree of conviction and clarity around the outlook than we've seen for quite some time. And I think this and changes that we're going to be implementing in portfolios makes us really encouraged about the future. So Alan will be expanding on some of these points in an economic overview that he'll be doing in the next week or so. And then I'll write to clients as well with some changes that we're looking to implement in portfolios over the coming weeks and months.